So my name is Todd Vermillier. I am a senior advisor in the Division of Supervision and Regulation here at the Federal Reserve Board. It is my pleasure to moderate the third panel. This panel is focused on facilitating innovation. The panelists are Mr. Michael Emancipator, Kelvin Chen, Philip Basil, and online, David Schroeder. So as before, we will start with some brief opening remarks, and we'll just work our way down the table if we may, and then we'll open it up for discussion. Michael?
Great. I think this is the non-robot mic. So good afternoon. My name is Michael Emancipator. I'm Senior Vice President at ICBA, Independent Community Bankers of America. ICBA is the nation's voice for community banks. I want to sincerely thank the Federal Reserve Board and the other federal agencies for being here and convening today's discussion, especially facilitating innovation, a topic near and dear to many community bankers' hearts. At their core, community bankers are innovators, serving as trusted institutions to accept deposits and becoming local engines of credit, jobs, and economic opportunities in communities across America. Community banks are truly an extraordinary and uniquely American phenomenon. As a means to further those trusted relationships, technology is essential to community banks. But community banks face structural obstacles that have little to do with appetite or ability and everything to do with the regulatory and market environment in which they operate. Let me set the stage. Community banks rely almost entirely on external providers for the technology backbone of their operations, including core processing, digital banking, payments, fraud detection, compliance reporting, and increasingly artificial intelligence. Most community banks maintain roughly 160 vendor relationships with a meaningfully shared classified as critical. Yet the market for core processing services remains dominated by a handful of large providers. 3 core vendors serve more than 70% of community banks. The concentration allows vendors to impose rigid long-term contracts, charge high integration fees, and limit data portability. The result is a paradox. Regulatory scrutiny of novel fintech partnerships can make legacy providers, precisely those most resistant to innovation, appear to be the safest choice in the examiner's eyes. Community banks report that partnering with newer technology firms attract heightened examiner attention even when those firms present a limited risk. More than 40% of community banks responding to a recent CSBS survey indicated that supervisory due diligence expectations impede the establishment of new third-party relationships. This is not an environment that facilitates innovation. It is one that inadvertently rewards stasis. So what should regulators do? ICBA has 3 concrete recommendations. First, establish shared due diligence frameworks and support standard-setting organizations. The average community bank is conducting duplicative, resource-intensive due diligence on the same providers as hundreds of other banks. Regulators can facilitate the development of shared due diligence infrastructure that establishes consistent baseline evaluation criteria and reduces the burden on individual institutions. Regulatory acceptance of third-party certifications developed under such standards could function as a form of regulatory passporting. ICBA is working with the Coalition for Financial Ecosystem Standards and other organizations to make this a reality on the private side. I encourage the banking agencies to join the exploration to solve on the public side. Second, modernize the framework governing confidential supervisory information. ICBA and the American FinTech Council recently wrote jointly to the banking agencies urging coordinated interagency action on CSI reform. Under the current framework, FinTech partners that design and operate key bank services are effectively firewalled from the examination process. When an examiner identifies a weakness requiring remediation, the FinTech responsible for fixing it often lacks the supervisory context needed to act. Exam findings get diluted or misinterpreted as they pass through layers of internal translation, and banks face uncertainty about how much supervisory information they can legally share with partners. Confidentiality and collaboration are not in tension. Modernizing CSI rules would make supervision faster, more precise, and more effective for everyone. Third, and finally, expand and modernize the use of Bank Services Company Act. Regulators already have the authority under BSCA to examine third-party service providers as if the services were being performed by the bank itself. ICBA urges the agencies to use this authority more broadly and more consistently. Let me close with this. If regulators make the environment for innovation inside the banking system too difficult to navigate, we should not be surprised when that innovation migrates outside it to less supervised, less transparent corners of the financial system that offer fewer consumer protections and safeguards. Community banks want to innovate responsibility within the regulated banking system with appropriate oversight. Our recommendations are not designed to reduce accountability, but to make accountability work smarter. We're grateful for this opportunity. Look forward to more conversation. Thank you.
Thank you. Kelvin?
Hey everyone, my name is Kelvin Chen. I coordinate policy for the Consumer Bankers Association. We are a trade group of basically where banks hit retail consumers, and we focus on the $10 billion plus market. And so although we're often confused with ICBA, and I'm not going to help it today because we actually agree a lot with what Michael had to say in the context of his remarks. You know, when I was looking at the title here about facilitating innovation, was really trying to think about what facilitating means. And in my mind, it's a couple of concepts. It's one, how do we innovate quickly? It's two, how do we do it safely? And importantly, the thing I would note is that these aren't adversarial notions, right? Like bank regulators should want, the regulated institutions to be able to innovate quickly and safely if we can find that balance. And so the question is, how do we do that, lest we also lose consumers and risk out into the non-bank space, as Michael mentioned. And so there's a lot to talk about, but I'd really like to focus on third-party risk management for a couple of reasons. And one, just kind of super pragmatically, is from an Administrative Procedures Act perspective, we're entering into sort of the back half of this election cycle. And from an APA perspective, it's going to be harder to put bigger things out for notice and comment, notwithstanding some stuff that just went out recently. And so my hope is that as we work on some of those bigger issues, that there are opportunities that are in the sub-regulatory space where we can work collaboratively towards some good solutions to advance innovation. So I have a couple of reasons to be optimistic, although the timetables are long. I'm a board alum. I actually used to work for Todd, full disclosure, and had the benefit of being here when we were trying to think through how the board would kind of have its own thinking around innovation-related risk and policy. And one of my first projects was a speech for one of the governors where we questioned, where do banks fit in the fintech stack? And so I wrote a speech about Pokemon Go, which may be why I'm not working here anymore, Todd. But the speech was basically about how the people at Niantic were trying to devise a product that they didn't know how it would scale. And they wanted to come to market quickly. And so the people at Niantic, if they tried to build their own maps, if they tried to build their own payment rails, all that would have taken years for them to do it. But instead, they put it on the phone. They relied on Google for maps, Twilio for text messaging, Braintree for payments. And then they launched in Australia first. So as the world turned, they could see that, oh my gosh, demand was 10x what they're looking for. But not only were they able to innovate quickly, they were able to do this resiliently because they were able to rely on their cloud service provider to then scale up the compute that was needed so that by the time the sun hit the US, they were ready to go. And so the question is, like, what can we learn from that, right? And I would note that was one governor, but this was a bipartisan effort, right? So 2 years later, I got to work with Governor Bowman on a similar question as to how do we help bring around innovation policy for the present realities of banking. So that's the good news, right, is that there are opportunities. The bad news is, gosh, that was a long time ago. Todd, that was 9 years ago. And since then, I think in 2023, the regulators all adopted the OCC's guidance, their then standing guidance. So that's a thing, right? That's somewhat progress. But when you think about how quickly the world changed, basically that same year, ChatGPT came out. And so TPRM is now also an MRM question, right? Like, how do we facilitate innovation so that you can rely on the technology and now the models of people that sit outside of where you sit? And so, I don't want to come here and say that I've got all the right answers, but I do think that we can work on this together in a public-private nature to try to get at some of these answers. So CBA is actually going to be working with the Alliance for Innovative Regulation, Joanne Barefoot, that spoke at one of the financial inclusion seminars here earlier. And we're going to invite in a range of banks and non-banks, regulators, and regulated institutions to try to work through solution sets and come up with practical things that we can do. The things I would note there is I hope that we kind of land on basically two basic themes. One is, how do we come up with reasonable expectations, right? So if you're a small bank, you're basically at the receiving end of form contracts with these bigs, right? The TPRM expectations of you being able to go in and ask for fingerprints and changes in terms, maybe a little unrealistic given the norms that we face today. So how do we think about right-sizing that in a way that actually reflects the reality of what banks actually face? And then two, how do we think about direct regulatory oversight and accountability here? One of the questions that we long batted around back then is, what would it take for the regulators to be a little bit more active in their oversight of service providers and then making clear as to what they're finding out there? And without trying to end on a sour note, I can only come up with kind of two good reasons as to why they wouldn't be more transparent. One is that you don't want to pick winners and losers in the market, and we get that, but we think that there are ways that you can control for that, particularly with industries in which they have just a couple of lead actors. And two, I can understand why it might be a CYA exercise. You don't want to be on the hook for saying this thing is okay or even this thing is 80% okay. The thing I would note, though, is, and to try to end on a compassionate note, that's what banks have to do every day. And my hope is that by working together, we can find some way to tackle these problems collaboratively. So with that, I think I'm at time, and I'll turn it to Philip.
Thank you, and thanks for having me. And my organization, Better Markets, which is a nonprofit, nonpartisan, independent organization founded to promote the public interest in financial markets, support financial reforms of Wall Street, and make the financial system work for all Americans. Too often the discussion today about innovation is reduced to talking points that say all innovation is good and therefore rules that slow innovation are bad. We feel that oversimplification misses the key point that well-designed rules are actually necessary to facilitate beneficial innovation. And that's because rules create the stability, confidence, and support that allow innovations to thrive by providing protections for customers, depositors, and investors. This process we're discussing today, where appropriate, should be used to support responsible innovation and avoid enabling or encouraging irresponsible innovation. In the past, irresponsible innovation virtually always has resulted in risks materializing that harm banks, their customers, the economy, and, in extreme cases, the American taxpayer. To avoid these outcomes, there are a few important principles the agencies must follow. First, it must ensure that the framework of rules remains strong enough to prevent unchecked risk-taking and to balance innovation with the trust and confidence that is the bedrock of a stable financial system. A strong rules framework should focus on factors such as securing customer funds, protecting customer privacy, and monitoring rapid growth and risks. Second, agencies must focus on banks and activities that would benefit the most from innovation and that pose the least risk. Importantly, this means focusing on improving the banks we have and not on unproven business models and unproven activities. Third, the agencies must focus on innovations that improve the ability of banks to meet the convenience and needs of communities and avoid innovation simply for the sake of innovation. Over the last year, it seems the term facilitating innovation, the name of this panel, has been a euphemism for ensuring that crypto assets become an integral part of the banking system, both within existing banks and by establishing crypto banks through special trust charters and so-called skinny master payment accounts. So, one concern of Better Markets is that the EGRPRA process will be used to strip back rules to benefit crypto banks and crypto-related activities. We feel this would fail to meet any of the three principles discussed. Crypto assets, including stablecoins, are inherently very risky, and there's little evidence they will improve the banking sector's ability to meet the convenience and needs of communities around the country. Another concern is that the EGRPRA process will be used as an extension of other efforts that are going on to strip back supervision and regulation for the largest banks. Instead, the agency should be focused on a rules architecture that enables innovations to improve the cost and convenience of bank products and services delivered to the American people. Importantly, that means the agencies must prioritize innovations that improve the operations and increase the competitiveness of community banks, which are the backbone of communities across America. Doing so would meet all three principles I discussed because community banks have lower risk business models and are entirely focused on meeting the convenience and needs of the communities they serve. There's a spectrum of innovations that would benefit community banks. At one end are more complex technologies that would enhance underwriting processes. For example, implementing advanced technologies that use customer cash flow data to assess creditworthiness for small dollar loans. At the other end are simpler technologies that improve back-end systems, such as for basic underwriting data and processing, record keeping, and risk management and compliance. Those technologies often are obtained through third-party service providers, and an example of a beneficial change that could be made would be to streamline supervisory assessments when the same third-party service is used by numerous community banks. Such improvements through sensible innovations would allow community banks to better meet their community's needs and to compete more effectively with larger banks by increasing efficiencies, improving customer reach, reducing risk, and lowering costs. The agencies must focus on benefiting community banks given how much they benefit the Main Street economy, including through this EGRPRA process.
Thank you. And now, David, would you please give your opening remarks?
Good afternoon, and thank you for this opportunity to present today. The Community Bankers Association of Illinois is proud to represent nearly 250 Illinois community banks. I'd like to discuss the topic of de novos and particularly chartering new community banks. I had the opportunity and the great pleasure to help organize 2 de novo community banks during my banking career. While that experience is now decades old, it's relevant now precisely because where we were back then is where we need to return to now to ensure community banks continue to be a meaningful part of our nation's banking and financial services industry. Tragically, in the wake of the great financial crisis, chartering banks was almost completely choked off by their inability to obtain deposit insurance. The dearth of community bank charters was an unreasonable reaction to bank failures in the run-up to the great financial crisis. However, the number of failures has declined sharply from 2010 to 2014, and since 2015, over a decade ago, there have been only a slight single-digit number of failures each year. The FDIC has tried to revive the formation of newly chartered banks, but those efforts have been insufficient to reinvigorate, and the number of de novos has remained stubbornly low. Much has changed recently with novel players seeking to enter the banking and financial services industry. It's now even more important that traditional community banks be able to successfully form and thrive as our industry moves forward into a new and vastly different competitive environment. In the quest to charter new FIs, the regulators must be mindful of maintaining a level playing field and not skew the pitch against community banks and in favor of those novel institutions. Looking now to compare what led to successful formations in the past and how that process should look today, we have 3 recommendations. Number 1, the capital rules continue to be incredibly daunting and should be revisited. Recent changes in projected capital and other requirements have been helpful, but more needs to be done to move the needle. We recommend that capital above a very reasonable minimum be able to be raised and added as needed, or for there to be a ramping up so that new banks can leverage their opening and early success. Number 2, an additional hurdle is the staggering amount of money banks must spend on specialized talent and many service providers to comply with a blizzard of new laws and regulations that touch on all aspects of bank operations. The banking regulators are tasked with tailoring regulation to the size and complexity of a bank. In the past, and unfortunately, particularly with the CFPB, this request was paid mere lip service. To a greater extent now, we're starting to see the tailoring of requirements being embraced by the regulators, but still more needs to be done. Number 3, there needs to be a determined and a positive attitude of all the regulators toward newly chartered banks. Before, there was an enthusiasm, collaboration, and support. That's not to say the regulators were lenient in their requirements, because they were not lenient back then, nor should they be now. The bank must have a sound business plan, be able to conclusively demonstrate their management expertise, and a sound board commitment, but that needs to be met with a reasonable chance of success, which has not always been the case. The journey on that road to success will start with knowing the challenges that were faced by each of the about 50 bank charters since 2020. The respective regulator's office of their ombudsman could be helpful in gathering this information on a confidential basis to determine what the regulators have done well and what honestly needs to be improved. The federal regulators should hold multiple outreach sessions together with their state regulators to explain the application and approval process and encourage those interested in moving forward. In the regulators' initial meetings with the organizers and as the application and approval process proceeds, there needs to be complete transparency, prompt consideration, and reasonable decision-making. The very measurable result should be dozens of newly chartered community banks being formed each year. This is not an unreasonable goal, and it must be achieved to support the health and well-being of community banks and the customers and communities they serve. Thank you very much.
Thank you all for the interesting opening remarks. And I invite all of you, there was a lot just said. Would any of you like to react to what a panelist said or put additional ideas on the table based on the discussion thus far?
I could pick up on, I think, what David was putting down, certainly. David, I think you and I have talked about this. How do we get back to a world where we're seeing more de novo activity? And I think this actually does go pretty well with some of the remarks that we up on the dais here were remarking about as well in terms of the technology. I find it fascinating that maybe this is an anecdote. Do you remember when flat screen TVs used to be ludicrously expensive and only the richest of the rich could have them? But as technology becomes more and more commonplace, I think my 6-year-old is getting a flat screen for her birthday in a couple of months, right? It's technology should get cheaper. If it's not the cutting of the edge technology, it should get cheaper over time, and we've seen that in a lot of different capacities. I think one of the reasons we don't see de novos is because there are such significant capital levels that are required, and one of the reasons is, I think, to offset the costs, obviously, of personnel, but also of the technology that's required to run a community bank. And the regulator wants to make sure that there's enough capital to burn through until there is an ongoing and viable business concern. If technology can be made cheaper, if there is an easier way to onboard new technological providers, perhaps you wouldn't need as much capital to have to burn through in order to meet whatever the regulator's requirements are for you to establish a new bank.
Yeah, on that point, one of the things we've written about in one of our reports around community banks, when you're talking about cost of technology, and Michael and I actually discussed this briefly a little earlier today, is this concept of consortia among community banks to be able to share the cost burden of all sorts of resources, whether it is the talent that is required to understand the technology and be able and therefore be able to comply with regulation and supervision, or perhaps it is sharing of back-end systems or third-party services just to be able to share the cost burden and make those types of technologies more accessible to community banks. And this is something that could happen through the supervisory framework if you allow, in fact, encourage the formation of consortia and cost sharing and resource sharing. I think that would be a huge boon to community banks and provide lots of cost savings to allow them to use and implement these technologies.
If I could add to that, I mean, one thing that struck me is how much we agreed on in this discussion in our opening remarks. And when we talk about the consortia, I would just note that I would hope that there's an opportunity and a role for the supervisor as well, because examinations are a risk management exercise, right? They're not a gotcha exercise. So we share the same goal of making sure that we're providing financial services in a safe and sound manner and in a way that's protective of consumers. It's not about kind of stumping one another. And, you know, way back in the day when we were thinking about how to structure kind of our system-wide apparatus around innovation, we use this analogy of the Avengers, right? Where maybe there's a way where we can call upon experts from around the Federal Reserve System so that if someone needs to go examine a model or a novel issue in this corner or this corner, you can pull together the same team of experts and go out there, and they would have the benefit of having done this before and bringing that kind of wisdom to bear. What I would note is that the goal there is that they're doing it over time, whereas for these community banks, they're doing it for the first time every time. And one of the things I love about coming to the board is you can make economic analogies. It's a guns and butter thing, right? Like, why would you have every community bank have to specialize in both guns and butter and fintech and crypto and wallets and AI when you can have a AI expert team at the board, a wallets team that can come in, and the bank will have to own the risk, like, at the end of the day, but we can talk about it and we can learn from what the regulators are seeing.
To pick up on that as well, hopefully, and I'm not sure, but you could maybe educate me too, like having at that point, was there outside expertise from, say, some of these companies that were also brought in to have the conversations also with maybe some of the banks that were using the technology to all be on the same, maybe literally in the same room as each other as things of this nature are going through the process? And if it's AI, or I like to go to the extreme of quantum computing, community bankers, I really would like to see a couple community bankers that have a PhD in data science, but I don't think that there are many out there that exist. So what are the experts that the community banks are going to be able to stand on their shoulders to be able to utilize quantum banking? Otherwise, in 10, 15 years, we're not going to be able to use the most cutting edge technology, or even technology that's a period of however many years old. It's only going to be a very finite group of organizations and maybe tech companies that are able to really understand the brass tacks, and community banks and all their customers are going to more or less be shut out of that huge opportunity, just because we're still contending with a framework that's really not meant to deal with that type of technology. It's I think a mind shift that needs to happen.
It's a great point. I mean, I think one thing that we were trying to do a lot more then, and it was trendy to have these offices of innovation where you would have outside firms and non-banks come to the board and talk about what they were doing, and we would bring in the other regulators and the consumer regulators and just hear from them and get a better understanding as to like how the world is shifting. It's my understanding that kind of in the prior and kind of more recent admins that has been less frequent across the regulatory space, but it has detriments. I mean, one of the things that we're dealing with right now is live legislation on stablecoins, and I think that there isn't a shared understanding as to how these stablecoin operators make their money, and we have to start with that before we figure out what the regulatory framework is going to be.
So I'm hearing a lot of agreement and some common themes, but I'd like to make it as concrete as you're willing to go. I invite every panelist. Is there something you would like the regulators to stop doing, or perhaps it's not a full, but perhaps it's at the margin, something you'd like to see less of? And flip side of the coin, what would you like to see the regulators start doing, or again, a marginal change of something we're already doing to do more of? And again, I give that to any panelist who would like to take it.
I have one. It's actually
go for it.
something that Phil said earlier. Is I wrote it down. Rules allow innovation to thrive, I think, is what you said. And why I want to hit on that is what could regulators do more of? And I'm sure from your position, it has got to be infuriating when you issue principles-based regulation. You hear industry say, no, we want more rules of the road. And when you issue rules of the road, you hear, no, we want principles-based regulation. And how do you square that conundrum? The way that I've internalized it is, if a bank feels like they know what they're doing, they want principles-based regulation. They don't want you to say X, Y, or Z. It's just the principles or the vibe type regulation. If they don't necessarily know what they're doing but see an opportunity, that is when more explicit guidance or rules of the road or ways to get involved is more beneficial to them. And I would wager that that is primarily, at least in the innovation technology side, more so the situation where community banks find themselves. So having more, if it's explicit guidance, more rules, more frequency. I think it was this panel talked about TPRM, and when the agencies merged the various guidance, OCC's reigned supreme, except for one part that I felt was very helpful, were the frequently asked questions that OCC had that were updated periodically. I don't think I would agree with all of the substance that OCC put forth in those FAQs. I don't believe that there was even an APA notice and comment where you could comment on those FAQs. I think that's something worth considering of re-implementing those FAQs, getting industry feedback, and that could be the platform also where you're borrowing the expertise of, say, private industry to have a sit-down with the agencies to really get into the meat of some of these issues, not just a one-off office hours of 30 minutes, nice to meet you, and you can tell the market participants, yeah, I met with OCC, they love us, but an actual work project that you can work toward together, some sort of results of being the answer to that FAQ.
Two things, Todd. One that's going to sound squishy, but it's not meant to be, and then one that's a little bit more granular. The first is a culture change, right? So there is a business school professor, Howard YU, out in Switzerland, that wrote a book about how great companies innovate. And what he noted is that if you surveyed middle managers and you gave them a bet, like more econ references, if you gave them a bet that was positive expected value, but had a 50% chance of losing a little bit of money and a 50% chance of making a lot of money, right? So the EV was positive, you should take that 10 times out of 10. The middle managers would never take that bet, right? Because there's a middle manager incentive to not be a loser, even if there's like a net benefit to the overall company and the enterprise, right? And so Yu's hypothesis was that it's the job of leadership to come in and set direction and to soak up that risk and say, we're gonna push towards that innovation. You guys can take that risk on. When we think about supervision, it is a risk management exercise, and whether it's the examiners, to what that trickles down to the people that are in the institution, there are a zillion different ways where someone is on the line and they have all kinds of incentives to not take that gamble, even if it's a net benefit to the institution, to the customer, and to society at large. And so we've got to think about how we change that culture, right? How we move from a gotcha culture, how we accept some degree of failure, and we focus on material risks. So that's a whole bunch of stuff, but that's a thing that has to change. The other is more granular. The FDIC Inspector General wrote a really thoughtful report about the FDIC's work with service providers. There's a lot to learn from that, both in terms of how you quantify the examinations, how you share out from the examinations, the cycle with which you did the examinations. There are so many tools that the regulators already have with the Bank Services Company Act and the stuff that trickles down with that, right? It's like that scene from Swingers, right? You've got these claws, and it's just like this rabbit, and you just got to attack the rabbit. Right, and so right, and so that's just the ask, is to utilize the authorities you already have in the game plan that's already been set out by the IG.
Yeah. For something very concrete, I mean, I think first and foremost, you're talking about concerted effort. I think there needs to be a focus on the community bank space. I know there's a lot of them, 4,000 plus. All have different needs, and they serve different communities and different business models, but there needs to be an actual focus on the community bank space. There's obviously, since the financial crisis, there's been a lot of focus on the very largest banks, and for good reason, and we should continue that focus. But I think there needs to be a group, or however you want to talk about it. And we've talked about some ideas here. You've talked about the consortia idea. You've also talked about resource sharing, and I think that's correct. It is very important among regulators and supervisors to be sharing information more so than they are today, and to be able to sort of look at best practices across community banks, streamline the supervisory process, streamline approvals process for third-party service providers. There's a lot that can be learned just from a focused effort on looking at community banks. I mean, we can talk about ideas all day long at this table, but it would be great to see the regulatory agencies pick up these ideas, take them, make a concerted effort to start implementing these things and trying them out. We also have to remember, and I think it was mentioned on an earlier panel, I think about the size we're talking about, and it depends on the definition you're looking at, but if you take the Federal Reserve's definition, upwards of $10 billion, right? I mean, can you smell a systemic risk around there? I mean, no, but we should, and so that's fine. So now that gives you a little bit more latitude to try new methodologies, to do more research sharing, to do some outside of the box thinking. I'm not saying, I mean, obviously you have to monitor certain risks, growth, getting into business areas where you shouldn't be getting into. So the supervisors need to maintain that sort of thing. But as far as the bread and butter banking goes, and usage of new technology, there's a lot that can be done.
Todd, if I could add something?
Please do.
I'm going to be very, very direct when I say this, but I think we're at a point where policymakers, including the regulators, need to emphasize really how important community banks are to the banking system, to financial services in general, small businesses, consumers, and the economy. And if community banks are indeed important, which I think they are, I hope you think they are, I believe you think they are, then more needs to be done versus just nibbling around the edges. We're at a point where we really think bold moves need to be made and significant accomplishments need to be recognized. And I know we're certainly there to help support the regulators in doing that and look forward to that journey.
Thank you. I'm going to direct the next question first to Kelvin, based on a side chat we had, and then I'm going to open it up. But Kelvin, are there lessons learned from other industries outside of banking that we can bring into the banking space and into the financial industry space that you think are helpful for promoting responsible innovation?
Thanks for asking, Todd. Yes. If you don't listen to the podcast Acquired, it's a great podcast. They had a wonderful episode on Lockheed Martin that really just had my head explode about third-party risk management. If you go back to one, if you think in the contrast, right? So it's been 9 years since the Pokemon Go speech. All we've done kind of since then is just adopt the OCC's guidance on TPRM. Contrast that to 1954, where the CIA needs to build a new spy plane. They went to Lockheed Martin. Lockheed Martin built the U-2 airplane under a circus tent in a parking garage in 8 months, right? And they did that, and it was all third-party risk management. All Lockheed built was the frame, right? They get the credit for the U-2. They didn't build the engine, they didn't build the spacesuits, they didn't build the camera, they didn't build the film, but it all worked, and they had that test flight in 8 months. They had it flying over the Soviets a year later, right? And so, how did they do that? If you Google around, there's this legendary kind of skunk works rule of thumb from the Lockheed Martin, Kelly Johnson era, and there are a bunch of rules there that really apply to our space, right? So rule number 2 is try to do things with 10 to 25% of the staff that you would ordinarily need, right? I think we all agree that the examination process could be much less kludgy and much faster. Rule 5 was streamline paperwork, document what's necessary, but eliminate the risk. Rule 8, push responsibility to the source. And so there was a real sense of don't re-examine your contractors. So push the contractors, examine them, but you don't have to do the examinations again, which is what we've been talking about here. And importantly, Rule 12, right? You needed mutual trust between the government and Lockheed Martin for this to work, right? It wasn't a gotcha exercise. This whole thing was done over a handshake and a check that was mailed to Kelly Johnson's house, and I don't recommend that. But they mailed the check to his house because they wanted to bypass the bureaucracy of even just the procurement process. I'd say if you contrast that to the F-35 has turned into a political durability exercise. There are a lot more suppliers because it's a different world, so they have 1,500 suppliers. But importantly, they make those items in 48 different states so that if they ever get questioned about why the plane's so expensive by a member of Congress, they can tell the member of Congress that a key part of that plane is being built in that state, which is why we don't have those planes, right? And so it's just when we think about how we're going to do this, we need that shared sense of urgency, and we can do it, and we can do it quickly. We just have to align on these issues.
I just wanted to follow on because with David's comment from earlier about the importance of community banks and just we talk a lot about innovation looking forward. I think it's also important that we think about the reason we have banks in the first place and why this whole system exists, and it is really supporting the economy and supporting in particular small businesses, Main Street economy. And just to rattle off a few quick statistics, the importance of community banks. As far as direct lending, on-balance sheet lending to the real economy, community banks use 75% of their deposits, whereas the 4 largest banks use only 40% of their deposits. Community banks have a higher loan approval rate through their relationship banking, and they have lower loss rates on their loans. I mean, they are so important, and they have a much outsized proportion of small business loans compared to their larger peers. They are so important and so vital to broad-based growth in the economy.
I love when it's not ICBA making that point, so absolutely, I could hear that all day. But I also want to go back to the other industries because I sometimes wonder it's a bit of lateral thinking, and which I appreciate. So my father is a retired research scientist, and so what he does in his spare time now is goes to laboratories across the country and more or less examines and certifies those laboratories. I say that without getting into the details of it. I had a conversation with him, what he did to examine these laboratories, the findings, etc. Tried to make the parallels of lateral thinking to banking supervision. It's interesting to me. I wonder sometimes what industry is more regulated than the banking industry in this country, and it makes me interested because my father is examining these laboratories where it's quite literally death or life with the results. When you get a test, when you have cancer, these tests are formulated in these laboratories that he's examining, and yet the medical world has, I would wager, does a lot of, obviously they don't have everything right, but a lot of great innovation on the medical front, and they've been able to find a way to allow outside, just say the FDA, to go ahead and examine some of these. So I don't want to really harp on just one industry or the other, but I like that question because it is a good way to get us out of our comfort zone to think, is there a better way to have our current ecosystem and do it in a supervised and safe way, but not the way that we've been doing it for the last 50, however many odd years.
We literally have 2 minutes left. We probably don't have time for closing comments from all panelists, but if there's anyone who would like to have a concluding thought, and David, let me start with you as an option only, but invite you if you would like to have a concluding thought.
You know what, we truly appreciate this opportunity, and I will defer to the gentlemen that are on the stage.
And thank you for just being open to this conversation. And we look forward to working with the board and the other folks up here on an ongoing basis. And large banks underwrite a huge number of subprime consumers that small banks don't. So everyone serves their job.
For all the agency staff in here, I really do appreciate you taking the time to just throughout, not just today, but the whole process. I think there are long ideas sometimes, and it is difficult to triage or start to implement some of those ideas. But whatever we can do, if we can find those small movements, ideas to start to implement, I'm there for it, and whatever we could do to help.
Yeah. Just as Michael pointed out, it is probably the most regulated industry, which means there's a lot of regulations. So we appreciate the complexity of the job and for having us and hearing us out.
Well, we appreciate all the panelists. Thank you for your time and your intellectual energy. And with that, we will conclude this panel.